Welcome to Property Sisters. This is Suzanne Oliver from Croft Property. I'm joined with Greg Ward today, and we're doing part 2 of our Ssas talk. I'm going to hand over to Greg first of all, and we're going to finish the slides from part 1, and we're going to do questions and answers throughout that and hopefully cover everything that the ladies have been asking me on WhatsApp. So I'm going to hand over straight to Greg, who's going to do a little introduction, and then he's going to put his slides up. Over to you.
Thank you, Suzanne. Sorry, I was just trying to share the slides there. So sorry, we sort of ran over a little bit doing the original presentation, so thanks for having me back just to run through the final bits. So I think we've got some really interesting questions just to finish up on, but also we'll probably do a bit of a Q&A throughout, which will be fun. So by way of reminder, I work within a business called Utilising, one of the directors there, and been there for 14 years, my one and only career, I hope. And we specialise in wealth management, so we've sort of spawned in the pension industry initially back in 1991 when the business was originally founded, and throughout the years successfully developed a very holistic wealth management business. There's more on that in the first section, so I won't sort of trouble you too much more, and equally please feel free to visit our website, Materially Woods PLC. If you just put that into the search, you'll find us, and there's plenty of detail there. So I'll jump straight to the slides. Okay, hopefully you can see that okay, Suzanne?
Yes, yeah, that's all up.
Brilliant. So we finished off part 1 by sort of looking at how you can use pensions, and we were specifically looking at SIPPs as well as Ssas. Because the first part was looking at some of the self-investment options around commercial property, which both can achieve. I just want to focus now on a Ssas loan back, and this is only allowable in a Ssas. It can't be done in a SIPP, and the reason for that is that when you establish a Ssas, you have a link to a limited company because the scheme is established as a sponsoring employer pension scheme or an occupational scheme. So because there's a direct link to that company through the trust deed, it also allows for some flexibility to loan back to that company from the pension structure. You can also have a number of different companies linked to your Ssas as well, so you can associate different companies, and this can be used to any one of those linked companies, providing it's connected by a deed. So what is a loan back? Well, quite simply, it's loaning money from your pension scheme back to your limited company. And it has to be a limited company, it has to be a trading business. And why that's quite powerful is that it allows you as the trustee and manager of your own scheme to have some control to loan monies back to your business, so to give cash flow. Traditionally, we might look at borrowing monies from a bank or any other willing lender, and equally that's still valid at certain times. But one of the advantages here is that you're paying the interest back to yourself, and you understand who you're borrowing the money from, because it's yourself, it's your own pension scheme, or it's your trustees of the pension scheme, of which you'll be one. So in order to have a loan back, you need to satisfy 5 tests. And the first one is that the value of the loan cannot exceed 50% of the scheme net asset value. And the net asset value relates to the amount of assets minus any liabilities, and that's your net asset value. So it's 50% of that as a maximum. Maximum term is 5 years. It can be shorter, but that's the maximum term you can initially establish. You have to have capital and interest repaid in equal instalments throughout the term of the loan. You've got to have a commercial rate of interest, and also a first legal charge as security on the loan, so it needs to be secured. Going back to something that we talked about was, the suitability of this. It's, I think a loan back is a really, really fantastic tool for those that it's suitable to use. because it just, as I said, it allows you to have a real understanding of what your pension scheme is doing for you. You can align it to your business interests. If your business is going through a growth phase or needs funding to assist with sort of purchasing new equipment stock, and again, that's part of your business plan, and it's very affordable, and you're not going to risk your pension assets because you know that there's a track record and a business plan to repay that money sensibly, then it can work really, really well. So it's all about having a strategy in mind. There's no point doing this sort of transaction if ultimately you're sort of pushing yourself and it's not going to get repaid, because you're just going to create issues and also risk. So in terms of security, what can we use? So we can look at a range of different things. Ideally, we prefer to have fixed assets like land, buildings, stuff that we can see, physically grab hold of. But if that's not always possible, then, again, subject to due diligence and suitability, we can look at wider options. So that could be share capital in businesses. Some businesses have extremely good valuation basis because they might have extremely good goodwill. For example, a business like ours, we generate fee income from a lot of clients. We've got a lot of value in that, and if we were to value our business, it would be on multiple of our earnings from fees and long-term clients. So that's just one example. Be similar for other businesses like accountants and so on. Or if you're a manufacturer, you might have real assets on there that would bring up the asset base of the business that could be used. But equally, sometimes we might still insist on second charges if we are using something like share capital, because it is a bit more unpredictable than, say, land or buildings. So we can use a range of different things, but that's always case by case. But I've put on there, not everyone's flexible, because everyone's got their own requirements, and it's down to sort of the requirements of the provider you have. So we did do a quick case study just to sort of illustrate the point of the loan back. And it was also to answer a question that someone raised around, can your pension fund invest in residential property? And the short answer is no. Your pension scheme can't directly invest in residential property. So, for example, if you've got £400,000 in a pension scheme, you can't go out and buy a house or a buy-to-let for £400,000 or below. Because under pension rules, you're not allowed to buy residential assets. And if you do, there are really severe tax charges, which is why it's never advisable. So the short answer, as I said, is you can't buy residential. However, I do have clients that are property developers, and they're limited companies, so they are set up as a trading business, and they've been trading typically for a number of years. They've got a good track record, and as it's their trade, property development, we can look at potentially doing a loan back to that trading business. And sort of we've set that out as an example here. So the clients have got a set of property development business. They'll buy unloved buildings, make them good and nice again, and then sell them on to the market or investors. And like any trading business, they're buying stock, improving it and selling it. That's their trade. So it is a trade, not an investment company, is the key here. So in this case study, we've got two directors, and they've had a good trading period. They've made some successful developments and have got some profits now in the business. So they'd like to save tax efficiently, and we've considered pensions because of the tax benefits. We get corporation tax relief on the contributions they make. More of that in the earlier session that we covered. However, they're naturally mindful of cash flow. It's always cash is king in the business. So whilst putting money into your pension to save for the future and save tax is a fantastic start, it means that they are going to reduce their cash flow. Now, we have identified that in this case study, they have actually got some previous pensions dotted around from prior working positions. So we looked at sort of their options, considered their position, And really what we wanted to try and deliver was streamlining their position, getting all their pensions in one place, looking at making a contribution to get some tax relief, and then utilising a Ssas loan back to allow liquidity to remain in the business for new projects. So this is how, in principle, this case study worked. We reviewed their existing pensions and found it was suitable to transfer them into a Ssas for both directors. And they had approximately £150,000 each. It gave them an initial cash pot in the Ssas of about £300,000. The company also wanted to make pension contributions, quite sizable pension contributions for the members, because they'd had a really good trading period, they'd sold some great developments, and they wanted to reduce the corporation tax. And as we went through in the earlier sort of presentation, we've established that these members can use something called carry forward, which means that they use their full allowance from the current year and some of their old allowances from the last 3 years that have not yet been used. So they're able to make quite a sizable pension contribution. And they will get approximately 19% corporation tax relief on that £200,000, assuming that it's they've got the profits and it's fully, wholly, exclusively qualifying. So now they've got a Ssas worth £500,000. So they put 200,000 in from their company, and now what they want to do is loan the same 200,000 or 200,000 back to the business. So they can do that up to a 5-year loan. Because they're in property development, what we've been able to do is structure the loan so that we set up the facility, and the first legal charge will be taken on new assets that are purchased, plus maybe some goodwill and residual value in the business as an additional charge. So there are a range of options that could be considered there to secure that loan to meet the security test. And then going forward, they'll pay interest plus any capital repayments back to the Ssas. So what, I suppose, has this achieved for those members? Well, they've been able to fund their pension quite considerably, which is part of their own retirement strategy to build wealth outside of the business as an additional source of retirement wealth. They've got much clearer control and understanding of the pension strategy. And this is now aligned to what they are good at and their investment strategy in the business. They've been able to loan up to, well, they could actually loan up to 250,000, because 50% of £500,000, which is the maximum limit, would be 250. But they only needed 200,000. So they've been able to loan the same money back that they've put into pensions to get the tax relief and grow their retirement wealth to keep cash flow. Now, clearly there are some risks, so we've had to consider these very carefully with the clients, and this should be something that is always done on a case-by-case basis. But it's really, what is their repayment strategy? How do they feel about managing that over the next 5 years? Is it affordable? Is it in line with the investment aims of the business? In this case, it was. Naturally, you've also got more eggs in one basket. So the pension strategy, on the one side, is good. It's linked with the business. It's linked with what they're good at. But at the same time, we've got to be mindful that it doesn't mean that there's more eggs in the business basket to a degree. So that really comes down to sort of our confidence in the clients, understanding their track record and their history, what they've got in the business, their strategy, the projects they've done and delivered on. That comes with just a bit of experience of trying to understand your clients. And making sure that it's suitable for them. And there's various sort of considerations we give into that. But ultimately, this is where it comes back to. It's not always appropriate for everyone, because sometimes somebody shouldn't have all their eggs in one basket. And they've got to diversify and look at different things. So it is horses for courses.
So on that scenario, just skipping back another slide, if you could, say people had pension pots, they don't need to be putting in the company contribution as well. They could have amalgamated those pensions to 300,000, and then they could have borrowed 150 into their trading company. So they don't necessarily have to be putting a new amount in. It can just be from existing pensions.
Yeah, absolutely right, Suzanne. Yeah, so it's a really good point. So in this example, we were just trying to blend a few different areas of the
Yeah.
pension arena, getting tax relief, etc. But you're absolutely right. Clients in that example would absolutely be fine.
And then the money's gone into the company based on security of the company, and they can use those funds for more development as long as they're comfortable that they can repay it within the 5 years.
Yeah, so I mean, again, examples of where we've done this in the past. Clients often might have sort of a 12 to 18 month strategy to sort of use that money to buy an asset and develop it, and you don't really want it sitting on your business much longer than that, because it
Yeah.
eats away at profit. So typically this works quite well for many of the clients that we've dealt with and done it for, because ultimately what they want is speed. So the loan back into their business has given them the cash to sit on, to sort of be ready when they want to go on a project. They can then use that money to go and buy a building. They can develop it, and they obviously want to probably turn it around as quick as possible. So, I mean, in the cases we dealt with, sometimes the clients have actually paid it off, the full loan, after the first year.
Yeah.
Just used it for that project, made the money, and then just thought, right, we'll settle the debt and then we'll start it again. So you can sort of once it's been paid off, you can just we can look at reinstating it. Yeah.
So the person could, in effect, do a property up, and if they don't sell it, they could refinance it onto more conventional lending and repay the funding. I think the one thing that might be worth just having a quick chat about is the capital and interest repayments that you need to make to the pension, because you need to have that within your business plan of whatever project you're doing, because it's not like a bridging loan where you're paying interest and it's rolled up till the end, is it? It's a proper repayment plan.
Yeah. So what, and this again comes down to having proper management of a pension scheme like this, because what HMRC want is to ensure that when you've got connected transactions, and this is connected because in this example you've got the client who is trustee of their own pension scheme and director of their own business, a controlling director. So they've got two hats of control. And so what we've got to try and do is treat this as on an arm's length basis. So that's why we have to have an agreement in place for the terms of the loan, just like you would when you borrow a mortgage. You have an agreement, so we have a similar document, and it's both parties need to adhere to that document. Now, it's not to say that if something goes wrong, we can't look at managing it commercially, because absolutely, that's the role of a professional trustee like ourselves in this sort of exercise. It's to try and have that mediator position if needed. And we have had to step in and sort of do that. And it might be that certain projects overrun. For example, right now with COVID-19, the world's a completely different place. So your original plans have just been smashed, and you've got to have some breathing space. So if needed, we can look at ways of managing the repayment position, either through a re-agreed repayment plan based on commercial terms. We might sometimes ask for maybe a sort of a secondary assessment from, say, someone that knows the business, like an accountant or advisor, that can sort of comment on the current trading position, just as a sort of a second pair of eyes, and sort of a repayment plan. But ultimately, yes, you need to go into it knowing that you're comfortable paying that money back in the agreed instalments. Otherwise, it's just going to create issues, and ultimately, the pension scheme would have to call on that loan if it wasn't repaid, and it equally couldn't commercially be agreed to under a repayment plan to sort it out. So it is, have to treat it absolutely seriously, and not go into it thinking it's just easy money, and I'll just, if I don't want to pay it back this year, I won't bother, because you can't. You've got to try and adhere to that commercial rule. Yeah. Or HMRC could, and what we have to do as a pension business is report on all connected transactions. So if a connected transaction hasn't adhered to the terms of the agreement, then we have to report on that. And we either have to report and say we've managed a new commercial position, or we report and say it's not been adhered to and nothing's been agreed, and that could create a tax charge. So it's really, I think you've raised a really important point there, which is it's really important to get it right and also manage it right. Otherwise, it can create problems.
Yeah. So that just needs to be built into your business plan for the project that's in your company that's outside of the Ssas as well. Fantastic. Yeah. Okay, go back to the slides.
So you did ask a question about can pension schemes invest in other projects or other businesses? Again, it's always down to provider flexibility, but ultimately, yes, the rules do allow it. And there's two ways in which that can be. Well, there's three ways that can be done. I've put one up here, which is unconnected loans. So you can loan money from your pension scheme, either in this case, a SIPP or a Ssas, to an unconnected individual. Technically, yes, unconnected individual or business. I'll come back to the individual bits in a minute. So unconnected means somebody that's not related either in business, so you're not co-directors, linked in the same business or group of businesses, and you're not connected via blood, via family. There is an official rules as well, I think, on the government website around that, which our technical team have. So I'm sure if needed, we can test those boundaries as and when appropriate. But in principle, they're the main two factors. Going back to the point I said earlier, you can loan to individuals or businesses. Now, if you're lending to individuals, strangely, you need to apply. Your pension scheme will need to apply for something called a consumer credit license. So, to be honest, we probably don't really do that much, or if any, because it's just another step and a hurdle. It can be achieved, but it's just extra admin cost, etc. That you think, well, actually, what's the point? So lending to individuals is something that we rarely do, and you'll probably rarely see, but technically can be done. And that's just to do with sort of new lending regulations. You've got to have that consumer credit license and meet certain conditions. So what we might see is sort of people will lend to other businesses, other limited companies, trading businesses. Now that can be, again, it has to be to a limited company, it can't be to a partnership or a sole trader, because that would be treated as the individual. Purpose of the loan is important. So why we're lending money to somebody is the first question we would certainly ask as a pension provider. If you can't just lend it, sadly I can't lend you money, Suzanne, to go and buy a nice new car or something that's not sort of for the purpose of your trade. So if your business is property development, pension scheme could lend to you if they chose to do property development, providing that's in line with your business purpose. If your business was a widget manufacturer and you just fancied buying a buy-to-let in the business just because it felt like a good time, we couldn't lend to that business knowing that the purpose was to buy residential buy-to-lets, because it's not in line with the trade, it's not in line with the purpose of the investment, and two, it's going to indirectly buy commercial property which is outside of that business trade from a point of view of development. So it would create another tax charge issue potentially. So purpose is important. It has to be for a genuine business reason. Due diligence is absolutely required. So we've got to make sure that the lines of connection don't mean that the money can or could circulate back to the member. And also that it's a genuine trading business which is trading well and the members have not got other risks behind them that we would look at. So it has to be considered very carefully. And suitability is key. So it comes back to me always to capacity for loss. What's the client's capacity to lose this money? Not that that's the intention at outset, but can you afford to tie up money in something that will be illiquid, like an unconnected loan? What happens if you need the cash back? Is that in your plan? Can you afford not to have liquidity? Can you afford the risk of the investment? Could you afford to lose some or all of it? They're all things that we would want to go through with the member.
I mean, there's a lot of ladies in our group that are looking at this, that have funds to invest in others, and many are already investing in others. So how does that differ from a loan back to yourself? How much is it unsecured that you're lending it?
So it can be either, well, technically it could be either. It could be secured, it could be unsecured. That's down to what is agreed. Ideally, genuinely generally as a pension provider ourselves and co-trustee for our members, we would always sort of say, why wouldn't we insist on it being secured, even if it could only be a second charge or something, because you sort of put it in your own shoes. If you were lending somebody, you were money on an investment basis, you want to know there's a fair chance that you're going to get it back. And I think that the security element just gives that extra bit of gravitas to the agreement, even if it's with someone that you might know well. It's just important, I think. But technically you can do it unsecured, but again, just got to be really careful there for the obvious reasons.
And does it have like an amount, any limits on that? Like you can only lend 50% to yourself. Can it be
technically
to anyone?
Technically no. So in theory there isn't with unconnected loans. However, as you'd expect, from a suitability perspective, we probably wouldn't allow somebody to use all their pension money to do that, because one, it really puts all your eggs in one basket that you're not in control of. It'd be different if you were buying a commercial property because you own the bricks and mortar. So that's and again, if it's suitable for the client and there's a story and the rationale, then that's generally okay. With this, because you're not in control of that investment, you're ultimately giving that responsibility to somebody else by loaning them the money to hope that they do what they do with it and pay you back. We probably wouldn't allow anyone to do that with the whole pot. These are only guidelines, but it is always case by case. Typically, we might say, up to 20%, 25%. Again, if the client's really high net worth and has got a very, very high capacity for loss, we might stretch it beyond that a bit more as well. So it just depends. It is, as I say, case by case.
So I've got a few questions. You've probably got these on the next slide, and I've interrupted you, haven't I? So thinking about who we're talking to here, some people might be wanting to borrow 50% of their fund for their own projects. They could then use, because they still have cash left in, they need to think about what they're going to do with the other cash, so they could lend that out to someone unconnected. So
in theory, yes.
Like a double strategy there. What about repayment terms? Is it different is it 5 years? Is it interest only, capital repayment?
So again, there isn't a status quo here because it is unconnected. The difference with a loan back that we went through before, because it's connected, it has very stringent rules just to sort of try and put in place some commercial limits. With an unconnected loan, that there isn't any sort of stringent tests. And I suppose it's because both parties are master of their own position, so they can agree a commercial position between them. So, for example, it could be exactly the same as loan back. You could have it as a 10-year loan. You could have it as a 5-year interest, interest only. Ultimately, in theory, pretty much anything could be agreed, providing it's sensible, suitable, etc. So yeah, it has got some more flexibility, but naturally more risk because you're lending to giving it to somebody else. So you've got to really be confident in that business or that individual in the business as well, or individuals in the business.
So in terms of implementing either of those strategies, do you need a solicitor involved as well, or is it something that you would do with your SaaS provider?
Again, it depends on the complexity. So if you're, in theory, if it was an unsecured loan, potentially the SaaS provider might have some of their own standard loan documentation they could use. So, that might be a slightly simpler road, but I'm not saying that means it's better. It's just, absolutely, I'd always go for security. If you're going to have a charge in place, we would then, involve a professional solicitor or whatever to sort of register that charge. And maybe even it's important in that case, they probably also either draft loan agreements, or if you're using other loan agreements, either from the provider or the members themselves, that probably the solicitor checks through that and links the charge with the agreements and things like that.
And one question, sort of just going back to the security, well, either way, if you're taking security, you would have to have a valuation done, wouldn't you, by a professional body?
Yeah, I mean, it'd be prudent to. I'd probably expect any good pension provider to ask for that, because, technically you don't, because it's unconnected. But I think, if it was me and I was lending money to somebody, you'd want to know that, the asset you're securing against is worth what it's supposed to be worth. I mean, in theory, if you for example, if somebody said, look, you knew the individual well, and you knew that they had a £1 million unencumbered property, and you were just doing £100,000 loan or something like that, and you just knew, then potentially there might be some sort of a commercial basis you could do without. But I'd say 99% of cases it'd be important to get something.
You should treat it just as if, you're the lender, as effectively as a lender would treat you if you were trying to buy it.
Yeah.
You need to cover your own protection.
Yeah, absolutely.
Okay, so that's both of those options. That's brilliant.
Here's one of the I'll just touch on, which is you can, because you did mention it before in our little chat, that you can buy shares in businesses as well, which are unquoted. So that's the other way you can sort of invest in other people's projects. So sometimes we've had a group of clients maybe want to club together and maybe buy into a larger project, and it could be like a commercial property, something like that. So sometimes they might have set up themselves like an SPV, special purchase vehicle, and they could do that either through a limited company structure or other. And then a group of pension schemes might buy into that, the different percentages of proportions. And again, within limits, the SPV can borrow money as well. So it's effectively like having multiple joint tenants of a property in a way. We can look at other things like that. You can also potentially buy unquoted shares as well. So you can buy equity in people's businesses if they're unlisted. Again, it's a massive amount of due diligence. It probably another step up there, because there are some really, I won't go into a lot of detail now, but there's some really stringent tests you need to check. And that's just to make sure that business doesn't own assets that the pension shouldn't be investing in, basically. So I won't say too much more, because we don't see it very much at all these days, but it technically is a possibility, just to sort of finish it off.
The SPV is a good one. That might be of interest to some people watching, where they can club together with the pots to do a joint venture project. That would be quite interesting for a lot. Okay, fantastic. So let's go back to your slides.
Cool. So I think that was sort of concludes the lot on the pension side of things. What I will finish off by saying on that is that, hopefully I've given people a bit of a flavour as to some of the things you can look at. Please, I must reiterate, I'm by no means recommending it for everybody. With these talks, it's just about trying to educate and just provide some sort of information so you can think about options if it's of interest. So the key for me though is just you've got to get advice because it's not always suitable for people. I'm sure we'll touch back on that later. One thing that I think a question was raised is what else? What outside of pensions? So we've bashed the pension drum because of all the wonderful tax benefits it brings, and there is, as I hope you see, a range of flexibilities. But for me, when we're sort of helping our clients with their long-term wealth strategies, it's about using different structures. And we touched on this a little bit in the first presentation, and there are, these are just some, but there are a range of different structures that we would commonly look at for clients. And I'm not saying everybody has to have all of them, because equally, if you do, fantastic. But you don't need to have all of them. But it's just about looking at the different sort of boxes that you can use in your plan. So as we've gone through, pensions, fabulous for tax relief on the way in, tax-free growth, and they're not part of your estate for inheritance tax. ISAs, they grow tax-free. You don't get tax relief on the way in, but they grow tax-free, and you can also access them tax-free. And you can invest in a range of things, from cash to stocks and shares, and different risk-based normal traditional investments. So they are also a wonderful tool to complement pensions. Pensions typically much longer term. ISAs can be short, medium, and long term. So they're a good sort of tool to have alongside. You can just own money directly, so what's commonly referred to as a general investment account, or GIA, and that's where it's not in any wrapper. But there are still some tax benefits to that we will look to utilise with some clients. So, for example, if somebody has no income, and maybe they've sold the business, stopped work, or they're not working, they can enjoy up to their personal allowance every year, £12,500 currently, of tax-free income. And there's a few additional allowances, like a savings allowance. There's also capital gains tax allowances of a little over 11,000. So that they are useful allowances that you can use through sensible investments to ensure that you have tax-free income. VCTs is one, venture capitalist trusts. They do provide some tax relief on the way in, so you can get up to 30% tax relief. And that's offset against any form of income. So unlike pensions, where for an individual it has to be against earned income, VCTs, you can offset income tax against any form of income. So investment income, rental income, bank interest, and so on. Dividends as well. So we often find that they can be quite an attractive vehicle for our sort of high net worth clients who have got the capacity to take that level of risk, because VCTs have a higher risk profile, because they are investment funds that invest in younger companies, sort of very unquoted or AIM-listed smaller companies. So it naturally has a high risk profile, but if you've got a long-term view and it actually can pay dividends, literally. Because VCTs also pay tax-free income and can be sold tax-free after being held for the minimum qualifying period of 5 years. So again, it's just about using different structures sometimes to complement one another. You've got limited company, so a lot of people in the group probably understand what limited companies are, but essentially it's just a vehicle from which you can carry out your trade, or in some cases an investment. And the company currently has relatively acceptable tax rates. Corporation tax is currently 19%. Who knows what will happen later in the budget in October? But they've been useful to sort of allow people to manage their sort of investments and trade position very well through that. And there are others on there, so I've put on there investment bonds. Investment bonds are a type of structure where the investments are held in a insurance-based product, and you can typically hold a range of assets like equities, bonds, cash funds. But one of the unique advantages is that you can access 5% of the policy value tax deferred over a cumulative 20-year period. So for many clients of mine who maybe have sold their business and have got quite a considerable amount of cash, is a great way to hold money, because effectively you can draw down tax deferred income for 20 years. And if you have an offshore bond, benefit from something called gross roll-up, where the actual investments don't suffer much tax on their accumulation. And they can also work well with other assets like trusts. Investment bonds don't produce income directly, so everything inside the bond just stays in the bond, so you don't actually pay any tax on the income generated on the investments in it. Internally, the bonds have their own sort of small tax rates. So again, they can complement other structures and trusts. So if you want to look at sort of cascading wealth within the family, and look at something long term, whereby there are some provisions around how the wealth is managed and who for, how you're directing the way the wealth is going to go, then trusts might be important. So these are just structures, and for us, it's looking at different structures to meet your needs. There's not one that will answer all of them, but typically it makes using a blend over time will actually give you some flexibility, and that's also because tax positions will change. If corporation tax was to rise, it might mean that the limited company structure is less attractive to hold investments. So actually, therefore, having some money in an ISA or a pension to complement means that you can turn different taps on at that point in time and not be so worried about sort of growing wealth in the limited company. So it just gives you some flexibility to sort of manage your position. So again, this is ultimately why. So it's all about income. We all want to try and build something that can support what we need, or what our families might need, or other loved ones if we're looking at legacy. And these are just a flavour of some of those allowances, where you can actually generate quite a considerable amount of tax-free income by using a blend of these allowances over time. Just the point I was trying to raise, it's not all about just going for one thing. We often use a blend to sort of just diversify.
And I think that's the same thing that we would say in property investment, is you want a blended portfolio as well, because there are peaks and troughs, and different areas of your business perform better at different times. So it's again with your portfolio, you want buy-to-lets, HMOs, you might have serviced accommodation, you might have commercial, but it's the blend that gives you that protection on your income in the long term, as well as, which is the same as what you're talking about with your cash, which is outside of that for the long term.
Yeah, well, a prime example away from property for a moment, we many years ago, pension schemes used to have very exorbitant tax rates on death. So they used to be as high as 82% when I started in the industry, and they sort of slowly loosened off to the position we're at today, which is very generous. But because of that, we used to probably advise a lot of our clients to spend the pension in a lifetime, because you weren't getting much of a benefit at the end. So, grow your wealth tax efficiently, absolutely, but then bloody enjoy it throughout your life. But since the rules changed, we for those clients where it's appropriate, we've sort of reversed that and said, well, actually, unless you need the income, maybe don't draw it unless if you don't need it, because spend money in your personal environment that now is the opposite, is subject to IHT, etc., etc. So it just gives you that ability to have flexibility. Yeah. So the one of the other areas that we sort of I think someone might have raised was just inheritance tax. So I won't go into well, I'll try and keep it as brief as I can, because it can get very complicated, and there are a number of things you can do, and I've put down what I will commonly look at as my 7 things you can do. There are probably more options to this, but this is just some of the ones that I will commonly look at with our clients. So firstly, what is inheritance tax? So inheritance tax is a tax on your death, and that's to go towards our sort of government exchequer and what their needs are for the country. So firstly, if you do pay, thank you to it's good contribution back into society. But But ultimately, it's something that can be managed within reason, subject to your views and what you need to do for your estate. So the current position is that each individual is allowed to pass on £325,000 of their estate without incurring any tax, and that's known as the nil rate band, or NRB for short. So as a married couple, you've got 325 each, or £650,000 as a married couple. And as a married couple or civil partnership, you can pass on your allowance. So if anything happened to me, my wife would inherit my allowance, so she would still be entitled to £650,000. So you don't need to, you don't lose it if you don't use it under current rules. Now, there is also an additional bracket called the residence nil rate band, and this was brought in by the George Osborne and Cameron government, and it's linked directly to the family home. So if you have a family home and it's being left to direct descendants, and also I'll come on to another quirk in a minute, then you are entitled to up to another £175,000 per individual.
Okay, I didn't know that.
So I'll just give you a scenario. So if you had if you were single and you had a family home worth £150,000 for sake of argument, and it did qualify under the residence nil rate band, you'd only get 150 of the 175. Yeah. So you can't pass the other bit on to something else. So it just links to the family home. If obviously though your house was worth £500,000, you'd get up, the full 175. So it's sort of that piece is just linked to your family home. The other nil rate band we mentioned earlier can then be added on top. So potentially it does mean though, for a married couple, if you do qualify for the full residence nil rate band and you've got your normal nil rate band, you've got £500,000 each, which gives you up to £1 million of allowances potentially. Now, you do need to get proper advice on whether you'll qualify for the residence nil rate band or not. The two pieces of sort of points to note that I would say from my perspective is, one, the family home needs to be left to direct descendants. So we always ask our clients to check the will. If your house is written in trust, it might not qualify because it's not to direct descendants, it's to trust. So just check those points with the solicitor to make sure it does. And also, there's another rule which says if your total estate, your personal estate, is worth more than £2 million, that residence nil rate band starts to get tapered and could potentially be zero if it got tapered enough. So for every £2 over the 2 million threshold, you'll lose £1 of that residence nil rate band. So if your combined estate was worth more than 2.35 million, essentially you lose that residence nil rate band on death. So that's just something to bear in mind. So again, one of the things, if people are trying to capture that allowance and they've got their estate in that sort of region, goes back to sort of looking at how, well, actually, are there ways to get it down to then keep that band, keep that allowance. So here's some things that we might look at from a point of view of inheritance tax planning if somebody wants to look at managing this consequence. So, the thing, actually going back a step, the thing I forgot to mention is, what is the tax rate? So if you after any allowances, your estate would pay potentially 40% tax is the standard rate of tax for inheritance tax. There are some ways you can maybe reduce that slightly in terms of the effective tax rate. If you leave up to 10% of your estate to charity, you can qualify potentially for a reduced rate of IHT, which I think drops to 36%. So there are certain thresholds that actually works out slightly better, strangely. but I won't run through that today. For some clients who've got quite sizable estates, paying 40% tax is something that might not be comfortable with them. So there are things you can look to do to effectively reduce that consequence, again within the legislation. So the first one I always look at is do nothing. Is it a problem? Are you concerned about it? I've got some clients that aren't, and they just say, well, it's they're going to get a fantastic legacy regardless, and I either want to contribute by paying more tax, I'm quite comfortable with it, or I'm just not too worried. Equally, there's not much I can change in my estate that would I don't want to give up the control. I need the assets to produce my income, and so therefore, c'est la vie, that's life, and I'm just going to not even worry about it. So that's the first thing, and that's absolutely acceptable, and a lot of people, some people take that view and they're comfortable with it. The second one is one I particularly enjoy, and that's spending your money. So it's never a problem if it's not in your hands. So just go and spend it, go and enjoy it, and that's generally make sure you. I think this is an important one. I often say to some clients, think about what you want, what you could do, and what you want to do with the time you've got. And that might be going on some of those holidays you've always wanted to go on with the family. Trying the new hobbies that you've got, whatever it might be. But it's just spend that money and enjoy it. Is often a fun one to do. You can look at gifts. So you can look at gifts so that money leaves your estate. There's many different types of gifts you can make. So there's a big list on the HMRC website, so I might not get all of them covered here. But for example, if your members of your family get married, so children, nieces, nephews, etc., you can make certain gifts up to certain amounts, and that qualifies as an immediate relief from your estate. They're only small, but still important to use. There's an annual gift, so each individual can gift up to £3,000 a year. You can also carry back 1 year or the last available year. So potentially, if you've not used it in the prior year, you could do 6,000 in this year, and then 3,000 each year after that. So again, that's a sort of small gift allowance you can use.
So the person receiving that, they don't have to pay tax on it either because it's a gift.
No, it's a gift. Yeah, so it's just because you're just gifting the money over to them, and because it's in those examples, it's treated as leaving your estate immediately.
Okay.
So you don't have to there wouldn't be any inheritance tax consequence on it either. If you want to make larger gifts, they might fall under something called a potentially exempt transfer, or PET for short. And basically, it's when it's not within one of these allowances. You might say, right, I want to gift, £200,000 to my children, and that could be into a trust, or it could be just an outright gift to them. There's different rules and regulations around each, but in short, you have to live 7 years for that gift to be fully exempt. However, after year 3, the tax consequence starts to reduce. So the actual the rate, the standard 40% bracket on that tax, if you were to die, would actually slowly reduce down from year 3 onwards to year 7. Ultimately, you can make larger gifts that can start to reduce the value of your estate, as long as you sort of it goes beyond those required years. So that's something that, again, is quite important to look at, because there might be, we've had lots of clients fortunate that have been able to help their children. It's probably becoming a more common theme now to get on the property ladder. So, whilst if you're in a relatively young position and have got the capacity to do that, that's, a fantastic way of getting some money out of the estate, and also really seeing your kids enjoy it and get some real benefit. I put will planning on there because inheritance tax is not always just about saving the tax. I think it's also about making sure that others know what wants to happen. So, an open question I think is worth everyone thinking about is, what do you want to happen when you die? And I think that the second great question is a colleague of mine in our business, called George Houston, is probably one of the most technical people I know, but he's also a great thinker, and he's equally shared this with me, and something I carry forward, which is, how would you want, even writing letters, like how would you want your kids to sort of conduct themselves, with the legacy they've been given or going forward. Even just writing, that doesn't need to be in your will, but just writing these things down so that, people know what you want to happen with the money you've got, the estate you've got, and also what sort of legacy you want to leave for your kids. So it's not all just about tax and numbers, it's, the softer things.
It does get more complicated. I know we've redone ours numerous times as we've grown over the last 20 years, pre-children and then after, and your view changes as well on what do you want to leave your children. Are you leaving them income, or are you actually leaving them a job? Will they want to run your portfolio if that's your intention, or would it be better for your child your will to say, right, just cash it all in for them? There's so many different things, and it's such a personal, situational thing, that some people don't want to leave their kids anything. I know quite a few people that you got to make your own way in this world, or you are doing it for your children, but then you want to have control on what they do with it once you're gone. I know one of the harder ones for us to get our head around was what happens if we both died at the same time, because we've got a big business that we run, and then who can take care of that? And that's why the will has to change quite often, depending on the age of your children, as to that outcome changes. I think obviously if it just passed between me and Jared, we could deal with it, but if you both went quickly, then that's a whole different element that we've included in our will now.
Yeah, I couldn't agree more. It's important to keep reviewing that, and they do say every sort of 3 to 5 years just have a little think, and it's a bit like I suppose it's no different than when you sit down and just review your business strategy. Everyone usually has a 3-5 year plan, and then they really look at the business and go, well, what do I want now? Because your views change, your ambitions change, your drivers change, and it's probably for the same reason just important revisiting your plans for legacy. What do I want to happen? As you say, do the kids want to become part of the business or not? If not, well, actually, what options are there from there? If they do, then again, what options do we need to put in place to make that happen? So no, I couldn't agree more.
I mean, I know you're going to go on to life cover next as well, but I think one of the big things is with a portfolio, you may not be cash rich. You've got a lot of asset wealth, but you're going to be taxed at 40% of that asset wealth. Where's that going to come from? Because you might not have it in cash. Where are your children going to get that 40% to pay? And I know we've got a mixture of things now to cover that. The Ssas is one of the ways we're trying to push property, or will do, in later years, into there so that it comes down that channel. And also we review our life cover as well, because you need something to cover that bill, which will be quite scary when it comes.
Yeah, no, I agree. So that's a really pertinent point. I mean, just on that one with life cover, so one of the things that you can look at is ensuring the potential cost of the liability. So if there is a tax liability likely, you can look at ensuring that cost so that the monies from the life, or the sum assured upon death, it's usually paid on second death, because with inheritance tax for a married couple or civil partnership, there's no tax consequences on the first death, because the other can inherit the assets without any tax issues. So it's only on second death that there's ever a trigger. So you can take out something called a whole of life plan on a second life basis. It pays out on the second death. On a second death basis, it pays out on second death. And the sum assured would then be paid into a trust. So you'd write it so the life cover is held in trust. And the reason why it's important you do that is that otherwise the life cover comes back in the estate and is taxed at 40%. So it goes into the trust. Once the estate's been calculated, the trustees can pay that money out to the beneficiaries, who can then use that to sort of pay off some or all of the liability to tax. There are two ways of taking that life cover. In fact, there's three, but the main two ways are a guaranteed plan and a reviewable plan. So with a guaranteed plan, as it says on the tin, the aim is that the insurance company is trying to keep your premiums the same throughout the whole term. So if you were, say, in your 50s and you wanted to take out a guaranteed plan, what the insurer would do is look at your health. They would look at your expected mortality for the next until that when they think you'll go based on all the medical underwriting, etc. But let's just say they think, you're going to on average live till late 80s. They would try and average the cost of that cover and their risk over, say, a 30-odd year time frame. So it would be quite expensive, but you do know what you're going to get at the end if you keep that up. So as long as you keep paying those premiums and you've got a strategy to do that, then in theory, your estate will probably get back more than it's cost you in the premiums. But it is sometimes a big commitment. So that just needs to be factored in whether that's worth it.
It's also cheaper the younger you start doing it, although
Yeah.
you're paying for longer, but sort of reevaluating at age 60, it's going to be an expensive premium. So if you know which way your business is going earlier on, it's good to look at then.
Absolutely. The second option, which is sometimes sort of slightly more palatable to take initially, is the reviewable plan. And with the reviewable, they fix the premium for the first 10 years, and then it's reviewed typically every 5 years after that. However, because of the risk is so low, typically for a married couple to both go at the same time, the premiums are often very, very cheap, and they sort of prey on the fact that most people use it as a bit of a plaster over the problem for now. But then when it does get reviewed at each sort of sequential review, the premiums will start to go up and drastically hike up as you get into sort of later life, particularly from sort of 70s onwards, because that's when the real risk is that actually something could happen, and the insurer will have to pay out a considerable sum of money. So we often find with reviewable, it's super cheap at the start, and then the cost overtakes what it would have been if you would have just paid a guaranteed premium over the time. But again, what we might often look at that for is, say, a client who is unsure what they want to do right now. It's likely later in life they will want to make gifts, but it's just not the right time. They want to have that control and the income stream from assets, etc. But definitely at some point they will want to look at it. So what they'll do is take out reviewable, and after, say, 10, 15 years of the reviews, then it gives them time to look at other strategies. So that's just one of those areas. Trust planning is another. That's simply looking at ways you can leave assets. So if you want it to be held in trust so that the controls with a number of trustees that you trust, so they can guide how the money is going to be used in line with your wishes. That's something that is often considered. You can gift into the trust assets, again, under the gifting provisions. And I suppose why someone might do that is they might need to, because they might have certain beneficiaries that need care or assistance. So we've often advised that for certain clients in that scenario. Or equally, they're just unsure, what's about sort of giving that sort of wealth to their children so young. And so they want it to be in a safe place where it has some provision and direction under guidance of others. So again, that's that's something that can be used. So yeah, I'll take a pause, Suzanne, in case you've got any questions.
Yeah, I think well, all of those really, it is something that you need to review every 5 years, isn't it? With your circumstances change, if you have children, if you get divorced, if you get any sort of life-changing event has an impact on, your inheritance tax planning. So yeah, I just think with the trust, that is another option if you've got children. What do you want it to pay out for university fees? Do you want to have some money that they can buy a house with when they're 25? Do you want to provide them with an income stream? There's so many different questions that it depends on your situation and what your child's like. And at what point is it just entirely up to them? You're controlling from somewhere you're no longer there, aren't you?
Yeah, I mean, sometimes as well, a common worry is if children are quite young and they've not yet maybe established a family and sort of hopefully a long-term relationship there, there is often sometimes a worry of maintaining sort of a family's hard-earned wealth in the bloodline.
Yeah.
And that's sometimes a concern that we see. So, using certain trusts can allow some flexibility to sort of help protect as best as possible against things like that, because it, ultimately certain trusts might have such wide discretions that it's not absolutely there for certain individual members. So it can just be another form of protecting for unforeseen events with considerable wealth. I noted as well, and the last point was number 7, investments with tax benefits. So there are certain investments that you can invest in that actually provide some relief against inheritance tax. For example, certain investments might qualify for something called business relief. Excuse me, I think my postman's just about to ring the doorbell, so you might hear a doorbell in the background. I might just need to go and answer that. Bear with me, is that all right? I'm the only one in today, so.
Well, it's on again now.
Okay. So the last one we were going to mention was the investments with tax benefits. So there are certain investments that can provide some relief against the cost of the tax from an inheritance perspective. So one example is investments that qualify for something called business relief or business property relief. And that might be if you've got a trading business. Again, this is pure an accountant or solicitor to advise on whether it's likely to qualify or not. But if you've got trading businesses that have been running for typically more than 2 years, there are a range of conditions there, but they might qualify. So they'll still be part of your estate value, but they might be exempt from the actual tax element. You can also invest in other assets that or hold assets that qualify for business relief. So an example might be certain shares on the AIM stock market. It could also be other types of trading business that may then hold a range of other qualifying business relief sort of trades. So again, there's some things that can be looked at for people who might want to keep control, but try and reduce the effects of tax.
Excellent. So
that was really it from me in terms of the main contents of the presentation. But again, there's a few more questions I think that were raised that we'll go through. But ultimately, there's big flexibility. And I just say with the pensions and everything, it's just about getting advice and a good team behind you.
Yeah. Do you want to unshare your screen and then we'll?
Of course, yeah. I will.
Well, I think I might be able to do it.
Oh, there we go. I always forget where it is on Zoom.
So, we'll go through some of the other questions that have come up repeatedly in our WhatsApp group. So the first one is differences in pension, Ssas providers. So we know there's a variety of people out there in the market. So what are your thoughts on the differences between the providers and what we should be looking at when we're looking for a provider?
Yeah, thank you for that question. So basically, I'd say the same whether you've got a SIPP or a Ssas. They're both, for me, they're both trust-based pensions. And I think something you and I spoke about this morning as well, Suzanne, was that this type of pension, if you want one that's got all the flexibilities and you want to do something a bit more bespoke, you want to treat it a bit like you would a business. You've got to have a plan for it. There's no point just setting one up and then just not doing anything, because you're just going to be paying the cost of that unique wrapper, and if it's not achieving what it's meant to achieve, it's not in your interests. So in some ways, it's got to have its own. You've got to have your own plan with it to make it work, and it's got to be a long-term plan. It shouldn't be a quick fix to get somewhere from A to B, just to achieve a simple solution elsewhere. For example, doing a quick loan back just to help some of the business. It's got to be beyond that. Otherwise, it just isn't going to work as a structure. Now, it's not to say you can't collapse. So you can collapse a SIPP and a Ssas and go back to a traditional pension. So it's not an all or nothing. If you go into it, you can unwind and go the other way. But the point is, go into it with the right mindset. In terms of a provider, the reason why it's so important is particularly in the SIPP industry, we've seen a number of providers fail. And we've had first-hand experience with that, in the sense that our business has been appointed now, I think on 4, possibly now 5 occasions, to take over failed SIPP providers. So the regulators have actually come to us and said, Matty Lewis, can you help? This provider's not able to run a sustainable business anymore. We've got all these clients with all these assets that need somebody to go and administer and look after the members' interests. That's a big job. And it leaves people in a real mess, and it leaves people really scared and worried, and people, it's something that we want to avoid. And the other downside of that is it also increases the cost of all the good providers out there, because they've got to the regulators then start to increase the levies under sort of pension protection fund, etc., to sort of cover for people that don't run proper businesses. So
levels of service then that they're actually providing to you?
There is a blend. So in terms of going back to the Ssas question, you can technically run your own Ssas. So if you wanted to set it up, it'd be a bit like a limited company. If you knew how to set it all up and do all the accounts and do the tax returns and manage everything in line with the regulations, in theory, you can become your own administrator. The downside of that is, and we've seen it sadly, is that if you get something wrong, you could have some big tax charges to pay. And I think there's another point as well, is that when you set up a Ssas, you become a trustee. And if you've not got a professional trustee, what happens if something happens to you? Either you're incapable of being a trustee, or, ultimate worst position, you die. So the benefit of a professional trustee is that a professional trustee is set up under a corporate structure. So, for example, in our own business, we have probably 20 people as trustees within our corporate trustee body. And because it's a corporate trustee, it's everlasting. So as those 20 people maybe change roles in the business, or some might retire and some whatever, then we can just change the names, but there's still the corporate trustee is going to live forever. So it means that there's always somebody there to act in the best interest of the fund, who's known the client, known what they need, and also the beneficiaries can turn to. Where we have seen issues is that if there isn't a corporate trustee, and something happens to somebody, the Court of Protection's then got to find a trustee. It might not be the trustee you wanted. Or it might be that that's given to some of the beneficiaries, and they might not want that responsibility. They don't know how to manage it, and all of a sudden they've got to do all the stuff that professional bodies should be doing. So it's not that it can't be done, but it can be. So firstly, you can do it alone. There are some businesses out there that sort of add a bit of flair to that. So they'll let you do it on your own, but they'll come in as a practitioner, and really they're like a bookkeeper in the sense that they'll just look at the position, maybe help with some of the administrative tasks like the tax returns and the registered pension scheme returns, maybe give some guidance on the way. But again, the same issues then arise with the trustee position. So a practitioner's not really taking on any responsibility. They're just there to help. It's the trustees who ultimately have the liability and the responsibility for the scheme. So although they might be a little bit cheaper in some ways, there is no real responsibility at their end from a point of view of the trustee position. And so hence why they're cheaper. And also they're doing only a small element of the real service. You've then got a full a full trustee practitioner role or administrator role where the business, someone like ours, for example, would be a corporate trustee as well as the administrator. So we would be working with the trustees to make sure the scheme runs compliantly. And our role is to make sure that everything's in line with the legislation. And if it isn't, we're equally liable. So we've got to put it right. And I think, as I said before, God forbid something happens to our clients. We know of our clients. We've had that relationship. We usually, over many years, got to know the family, and that trust is there. Hence the trustee role to then make sure that things are managed as others want it to be. So it's really down to there's a complete range of service. Again, we also add the advice bit on. We are an advisor as well, so we've added another level on top of that. But it's down to sort of finding what works for you. My own personal view, and I would say this, and it's not because I'm biased, but just because I've seen it go wrong on occasion, is I'd always get a proper business with a professional trustee. I'd always look at the business as well. Look at the track record. How long have they been established? Maybe look on Companies House. What's the balance sheet like? Get testimonials. See if any of the individual members that have run that business are regulated. Have they got any prior issues on Companies House, etc. You've got to find someone who's reputable, because sadly with Ssas, they are technically an unregulated type of pension scheme. So anybody can set up as a Ssas practitioner, potentially also as a sort of Ssas administrator. So you don't need to have the same sort of capital adequacy or funding in your business that you would normally for SIPPs, which are fully regulated pension products. So that's why you can have a complete mixed bag of people out there running Ssas, and so just be careful.
So that's why it's equally as hard to compare fees, because they're not comparable unless you're actually looking at companies that are offering exactly the same service. And I know we've talked about it a lot in our group, and it's not that easy to identify like for like in this scenario. So I think those points that you raised are brilliant about you are investigating the trustees and doing the due diligence on that company, because what is there? This is a lifetime investment, isn't it? What if they've only been going for a couple of years? What's going to happen in 20 years? And I know, like balance sheet and things like that, as a company, you have your own investments, don't you?
Yeah, so we firstly, we don't look after any, we don't hold, so rephrase that, we don't hold any client assets on our balance sheet. So all our clients, this is the way it will always be set up. Gone are the days of Robert Maxwell, but all pension scheme providers out there should not hold your assets, full stop. They should only survive as any credible business through providing a service and making sure that they charge appropriate fees for that. They can run a business sustainably, cover their own costs, compliance, regulatory levies, pay the staff, and grow and be sustainable. So, we as a business for example, we're very careful on how we manage our own money. One of our sort of core pillars of our sort of principles is if we can't manage our own money, we shouldn't be allowed to manage anyone else's.
Yeah.
And that goes for us as advisors as well as as business owners running the business. And that's something that we strive to always make sure we can do. And the other thing is making sure we've got a legacy plan. So as I said earlier, Ian and Bob, who founded our business, probably would have been far easier to sell it, but they listed our business so that we did have a legacy. We could then make sure we retained good quality staff. They all had great career opportunity. We invest massive amounts in our people and our sort of infrastructure so that we've got a legacy, because one day I will want to retire. So I need to make sure that the clients I have can also cascade down into a safe, sustainable business. And equally, I want that for my own wealth and that of my families. I want it to cascade down to people I entrust. So I think it's about also understanding what your business that you're dealing with, what their succession is and what their plan is. Because it is, pension will last with you and maybe the next generation.
Perfect. So I think we've covered an awful lot in our time. Thank you very much for spending all this time with us. What we'll do is we'll put your contact details back up again at the end of this session. And I think the sort of overview of it all is it's another arm to your business. It's another investment strategy for which you should have a proper business plan, whether that be for the Ssas on its own, if that's your chosen way, or your SIPP, and to look at what you want to happen with it in the end. I know a lot of us, it has been a hot topic at the moment for borrowing money to use on your own investments. But what happens after a couple of years when you've done that? There are fees involved, quite rightly so, for the privilege of being able to use one. So what are you going to do with that money for the next 20 years or 30 years? And also the structure for passing it down to your children. That's the structure. The reason we did a Ssas was we had profits in our company, so we reduced corporation tax. We had pots all over the place that we pulled together. And then also it did come from capital gains tax planning, really, for our daughter. And she is part of our family Ssas. So she, will inherit all of the properties within the Ssas tax-free. So it's got real longevity for us. It's beyond our lifetime, and I think that's what you need, a provider that you can feel assured that it's going to be there in the same way, not just, it's not a quick fix.
Actually, I agree with all of that.
So do you have your little slide with your contact details? And we'll pop that back up. And any questions, or if you want to take it forward, Greg's happy to have chats with people. It's such a personalised area that there's not one rule for all.
My colleagues, James is also in the session with us, just sort of standing by. I know I've done all the talking today, but he's part of our team in the Northwest. So there's many consultants in the business as well. We've got about sort of 70, 80 consultants around the UK. So we span all regions, and I'll put the main office details there. So if you do want to get in touch, please do. My own personal email there and James's. So we're more than happy to help people if they just want to have a chat.
That's brilliant. Thank you very much, Greg.
No, my pleasure. Thank you, Suzanne. Hopefully I'll join you again, but no, thank you so much. It's been great to sort of be part of the group. So I hope it's useful.
Brilliant.